Hi guys, I'm Wolf. I represent Samada in the Samada Research Institute, and here's what I want to talk about. I want to talk about the Internet of Trust and the data and intelligence. Before we go in that is, I want to talk about how we got to the problems that may necessitate the Internet of Trust. And so I want to talk a little bit about Internet-based platform companies, and I want to talk about how they evolved. Most of us know this, but it's sort of important to reiterate that crypto and the crypto community and the technological solutions are really an extension of those Internet-based platforms. So if you think of us as an extension of the Internet.com bubble, 2000s and forward. And so we have a very significant exposure to trust issues on the Internet. And the way that we at Samada look at this, at Samada Research Institute, is we believe that the only way to really remedy this is through reputation systems. So reputation systems, fully decentralized reputation systems that help build trust on the Internet. And so I'll talk a little bit about how we're getting there, and so let's start with this. So we all know platforms and the exponential trends in innovation. We are somewhere at the knee of the curve. When we add blockchain, DLT, sensors, IoT, deep learning, AI, all these solutions together are creating a surge. I think there's a lot of support for this. And so the exponential trends in innovation we can assume to continue. Of course, that had quite a significant impact on existing businesses. If we just look at the S&P 500 and what happened to S&P 500 companies in the last 15 plus years. So again, correlation is not causation, of course, but if we look at the exponential growth in technology, crypto is, of course, a huge part of that. We are, again, at the knee of the curve, and we saw 52% of S&P 500 companies disappear. Now, most of those companies had some sort of brick and mortar business that had exposure to Internet-based platform businesses, meaning competition exposure. So what are those competitions? Well, we all know the traditionals are the car industry competing Mercedes with Lexus and BMW, but today, really, that's much more Tesla, Uber, Google. Yeah? So just to illustrate some industry verticals in this context. Same with wholesale, Costco, Target versus Walmart. That was sort of the traditional 60-plus year competition. Today, of course, we're talking about Alibaba and Amazon as very dominant competitors. And we don't even know where this is going to go with all the things that Amazon is building. So similarly for internet providers, Verizon, Time, Comcast, also content providers, same story. There's tons of studies, hundreds of studies on how successful Netflix is. And of course, they are the dominant competitors right now for content. And all of these are internet-based platform businesses. And same for payment systems. So these are the traditionals, and I'm only listing the centralized competitors. So PayPal, Alipay, and so forth. I'm not even getting into what we're doing in crypto to help customers and consumers in this world. So, but the best illustration maybe is a traditional brick and mortar business. In this case, Marriott versus Airbnb. Yeah? So, I apologize, this is older data, but we're looking at a 90-year-old business versus a 9-year-old business. And we're looking at 1.1 million rooms and listings available in 110 countries for Marriott versus over 2 million in more than 191 countries for Airbnb. Employees, Airbnb does it at a fraction of what the brick and mortar business requires. And yet the valuation is almost double. That is an illustration of how much more competitive internet-based platform businesses are. So, how do they do it? Well, they're asset-light businesses. and some of them are more asset light, as you can imagine, than others. But so we have the platform businesses on the right-hand side, and with extreme asset light perspectives. I listed here just the top businesses: Amazon, Alphabet, Apple, and so forth. Yeah, most of us know all of this, but I think it's important that we understand what that could mean for those businesses and for crypto as well. So what are the implications of having extremely competitive asset-light businesses competing with traditional brick-and-mortar businesses? Well, it changes dramatically their governance structure. So in the asset-light businesses, we simply don't see the same governance structure as we see in traditional brick-and-mortar businesses. So we all grew up in a centralized society, and with that come hierarchies, control mechanisms that are hierarchical, and we're all used to that. Shareholders on top. These are the traditional hierarchical governance metrics that we have lived with, all of us, for most of our lives. Now, for the asset-light platform businesses, that's really different. There's a very strong belief in those communities, those businesses, that we really should be looking more at ecosystems, networks, empowering structures, experimentation, collaboration, co-creation, and very flat hierarchies. That's the key. Flat hierarchy, best idea wins. And there's a ton of research that's available on this, and so the governance structure is really dramatically different. So what does that mean in terms of future developments? So let's look at this metric. We start on the left, so open and flat hierarchies. Yeah? So the more open you are on the right, and the flatter you are, you're on the right top. Right? So we start out with hierarchical closed governance. We all know them, GE, all the to Marriott's and so forth, are very hierarchical, very dependent on those top-down governance arrangements. Asset heavy, very asset heavy. Then we have the mixed platforms, sort of in the middle, with Amazon, and Amazon, of course, having competed on having the largest inventory in the world. So they still have assets. Same with Apple. Yeah? Google, Airbnb, probably the most open of the existing internet-based platform businesses. But where this is all going, the ultimate, so the epitome of where this is going is the DAO. So I really would like to postulate here that the DAO is the antithesis of the traditional hierarchical models that we're all used to. Yeah? Of course, the question then becomes, how realistic is it that we can actually build new solutions on DAO-centric governance structures? And what do we need? Well, we can, I think, long story short, we can all agree that data and intelligence-driven enterprises win, period, when it comes to governance, but also on all the comparison metrics, business metrics. Yeah? I've just shown you some examples, some basic examples. So, data is the new oil, is one way to look at it. Intelligent information is the new currency. So, of course, if we look at this in crypto, I would argue that crypto is an extension of that business. Yeah? So these business lines that I've just illustrated, and their performance in comparison, crypto can be an extension of it. The problem, of course, is what? Well, a lot of people believe in this, right? Oh yes, this is wonderful. We have more adoption, especially this and last year. The hype was unbelievable. Yeah? Yet we really don't have substantive depth in technology in crypto. We have some basic solutions that are sort of workable. Yeah, so I teach coding for lawyers. And we experiment with those solutions, and there are solutions, but we're still super early stage, right? And I actually think that this graph is maybe a little bit more illustrative, if you want, and maybe also a little bit more accurate. Now, in crypto conferences, this is sacrilege. You're not supposed to talk about this. Yeah, I'm talking about this. I think it's really important that we all understand that this is happening. And a lot of the top players, including top 20 coins, they are sort of trying to brush over these trends. Yeah, and I think it's very important for all of us to really figure out what is the burst or the purge, whatever you want to, the culling, whatever you want to call it. What does that mean? Wall Street Journal, Thursday or Wednesday, front page. I never cite the Wall Street Journal otherwise, but in this case I do. Talking about how bad the crypto market is. Front page Wall Street Journal, naming some of the top coins and critiquing them with particular emphasis on lacking solutions. Lacking solutions in real commerce, lacking solutions in actual trading. Arguing that all these coins do is trade. Now, that's probably not quite accurate, but this is front page material. Yeah? So the burst, I would actually say that the burst here is much worse. We're somewhere down here at this point. The burst isn't on an upward trend. We really have a very significant correction in that market. So the question becomes, if crypto solutions, DLT businesses, emerging tech, so a lot of people are even moving away from the DLT terminology now. Okay? So it used to be blockchain and it became DLT. Now people are saying, oh, emerging tech, right? And crypto is part of that. So if emerging tech went through this burst, what is coming afterwards? Well, we believe that there is very serious exposure to trust issues. So we believe the data, and so I'm quoting here the Edelman report, 18 years of data, over 33,000 participants. So it's a really big data set. And they're looking at trust issues with platforms. And if we just look at sort of, this is only 2017 to 2018. If we look at just the United States, here in the middle, minus 11. The largest of any drops in the data set, only for those 2 years. Yeah? So trust in platforms decreases. Well, we know that these platforms are outcompeting brick and mortar. We know that crypto can be an extension of that. Yet we have this data that suggests that worldwide adoption may be subjected to this trust issue. Yeah? And so that's what Samara that's what we are working on right now. So let me illustrate this a little bit more. And I don't want to offend any millennials in the room. I'm just quoting data here. Yeah? So the trust issues may actually have a generational dimension. Again, correlation is not causation. We'll be very clear about this. So if we just look at this basic question, can most people be trusted? Baby boomers say 40% yes. Generation X, 31%. Staggering. Millennials, 19%. Now, we can remedy those trends, of course. Yeah, there's ways to deal with this. But if the millennials' children continue this trend, I think that's a larger issue, not only for society, but especially for companies and enterprises such as internet-based platform businesses. They have major exposure. Yeah? Now, some of you may say, well, there's really no way around it. We have the exposure. We all have to connect through the internet. There's no way around it. But think about what we can do in terms of adoption scenarios and proliferation of internet-based platforms if there is a way to fix this problem of trust on the internet. Yeah? So, but let me continue a little bit. Fake news. Everybody knows this. My marketing people actually said not to put this slide in because it's too political. I still put it in. So this is, again, Edelman data. 7 in 10 countries worry about fake news being used as an attack mechanism, as a weapon. Yeah? And so this has been proliferating, this issue of fake news, in the last 2 years or so. Yeah? We all have seen the Russian trolls and the way they manipulate and create these fake news. And so this is all sort of contributing to this issue with trust on the internet. Next one, cyber attacks. So many of you will know that today, anyone in this room, and I'm not suggesting that you should, but anyone in this room can spend $5,000 and hire the Mirai botnet or any other botnet and bring down major internet-based companies, well, at least the web page, for a few hours. Anybody can do this. You just have to mess with it, find the right context, pay the $5,000 in Bitcoin, whatever the currency is, and you can do this. And I'm not telling anybody to do it. I want to be very clear about this. I'm not suggesting this. But the message here is the costs have come down tremendously. It used to be an elite group of people who could do it. Now anybody can hire hacker groups to launch attacks. Yeah? So what does that mean? So again, data, 2018, cybersecurity incidents, we have exponential trends. Well, let me cite some Cisco data. We're talking quite regularly with Cisco. They estimate that by 2020, we will have 50 billion IoT devices on the internet. I don't even want to go into internet scaling issues at that amount of devices on it. But in terms of cybersecurity, these devices, they don't get regularly checked. Once they're installed, they are sort of an island to itself, right? Attacks can be much easier diagnosed and seen if you have a user behind it, somebody who uses his or her cell phone, right? These attacks get typically detected quicker if there's a user behind it. If we have IoT devices being installed, 50 billion by 2020, and they don't have a decentralized authentication methodology behind it, and they won't right now. Now, Cisco's working on solutions, IBM, they're solutions, decentralized authentication protocols. Yeah. But for now, we have to assume that these trends will go up, that we can't even estimate where this is going. Yeah? The issues with cybersecurity. Okay, so the data is very clear. Worldwide, the trust is down. Yeah? People are more and more worried about this. So if we just look at the United States, most extreme trust losses, minus 37%, United States. Now, there's some political issues involved in that, of course, that I don't want to get into, but the data is very clear on these issues. So who can fix it? Can government fix it? Well, the data suggests that most of the CEOs in this, who were surveyed in this survey actually feel that it's their main responsibility to increase trust in their own solutions, in their own company. And the previous speaker, we talked a little bit about regulation. It's very unclear if regulation can fix this. Yeah? How are you regulating baseline trust issues that people have with the internet? Now, there are a lot of top-down approaches. I'm not quite so sure if that's going to work. Okay, so here's just one study. 450 buyers. This is automakers. And the baseline is that low trust revealed the need to spend more time and resources for communication, negotiation, and compliance. High trust, in reverse here, led to greater information sharing and a willingness to sacrifice for the product. Yeah. So think about what that means in terms of transaction costs. The higher the trust in a given environment, in a given business, or in a given technology, the lower transaction costs. Yeah. So if we can figure out a trust-based business model, what we call the Internet of Trust, we can significantly lower across the world, I would think, the transaction costs. Yeah? So how do you get trust on the internet? How do you build trust on the internet? Well, our opinion is that the only way to do this is through reputation systems. Now, we've heard a lot about reputation systems, and here's how the existing internet-based platforms are trying to deal with this. What they do is they force the real you, the real consumer, to build separate personas, right? So you have a social persona for Facebook, you have a merchant persona for Amazon, you have a business persona, a travel persona for Uber and Airbnb. Yeah? So, but what is the problem with this business model? With this baseline business model using trust metrics? For internet-based platforms? Well, here are just some. First of all of them can be Sybil attacked. What does that mean? Every single one of those systems allows you, anybody, to create fake internet accounts, sock puppets. Yeah? You create sock puppet accounts, and what do? You use the sock puppets to vote up your real persona. Yeah? You give fictitious reviews to your real persona, so your actual reputation. And so it looks like you have a higher level of reputation than other people, just because you created those sock puppets. Yeah? On Samada, that's the one thing we cared about. 2 years ago. Spent 2 years just on the mathematics and architecture, just to fix the Sybil attack issue. Yeah. Every single system out there, including hundreds of crypto startups, hundreds, they're all talking about a 30-year-old idea, a baseline idea, web of trust. Yeah. And all of these systems are Sybil attackable. Now it works until the stakes are high enough to attack it. Yeah. And we have top 20 coins who have not fixed that issue. Okay, next thing is you don't own your reputation. If you interact on these platforms, the platforms own your reputation. You're building trust for the platform in some ways, because they own that information. If any one of those accidentally deletes your profile, any trust that you may have built with the community with which you're interacting on this platform is gone. You have no ownership, no control, zero backup. Yeah? They control it, they own it. All of these, and because it's all built in and by the platforms, all of this information, all the scores, all the data, including financial data in some cases, is all trapped in these silos. We have no interoperability. Yeah? And anybody who's developed networks knows interoperability means survivability. Yeah? That's how the internet was built. You had to develop protocols that allowed you to interoperate with others. Yeah? Without that, it was useless. Yeah? Okay, so because these folks are trapped in silos, you own your reputation. You can't build social capital. You can't use it and invite other people as a conversation starter to build new revenue models on top of the reputation that you build in a given existing platform. You can't do that. So no privacy. Anybody can look at it. Any employer can access internet data to the extent that it is public and review it. You have no control over that. Yeah? So the Europeans have passed this directive, the right to be forgotten because of this. We have also no reputation, data autonomy, and no network effects. That's really crucial. That's really where we want to in many ways start the conversation. How do you create network effects? Well, in this model you can't. Nobody can use these siloed reputation scores. Okay, so we look at this a little bit differently. Yeah, so we look at this from the perspective of how do we give, in quote unquote, it's a little cliche, but how do we give the sort of, because most crypto startups talk about some of this, how do we give the power back to the people in this case? Yeah? I still say it. So for us, it's really key that you, one, control your personas and your reputation, and that you interact with these platforms through a reputation score and a reputation metric that you can actually control. So we use interoperable contextual reputation scores. So the biggest benefit of that is, of course, we're removing data silos, and we're creating interoperability. And as I said earlier, everything we did in terms of mathematics, architecture, the whole concept is built around Sybil attack resistance. There is no point in building anything like that unless it's Sybil attack resistant. And my co-founder is a mathematician, so 2 years ago he said, if anybody can break this, I'm done. I'm moving on. I'm doing something else. And then, folks couldn't. So here we are. Okay, so next thing is that you control your reputation. You are the one who's becoming part of, in Samata, we build reputation in DAOs. Yeah? Your reputation score is a DAO score that you're building within the Samata framework. Yeah? And lastly, you have full data autonomy. You control it. Yeah? That's all fully secured through our proprietary network. And there's complete privacy. If you decide to share your score as a conversation starter, you can so choose, but nobody else can force you to disclose. It's your private score. Okay, so what do we get out of this? Well, the key element here is network effects. absolutely key to this. Yeah, interoperability, social capital, the data that we're using, and self-sovereign identity. And I know I'm throwing a lot out there right now. They all together, you have significant network effects. Now, if you're asking how can you quantify those, we can't right now. Yeah? So it's still conceptual. But it's also new network data. Those reputation scores, so rich context reputation graphs is what's called. It's a completely new data set, new way of looking at reputation data. Again, social capital, and then lastly, self-sovereign identity. What is self-sovereign identity? And who cares? Well, millennials really care about this. Yeah? So who you are on the internet in various networks right now is controlled by those platforms. You don't own that data, but you should. Yeah. So to control who you are in those networks and what defines you in those networks is called self-sovereign identity. And then you control that data. Okay, so before I move on, let me say a few words about Samada. So we believe that in order to fix these issues that I've identified, that are sort of at the core and that hinder, in many ways, a full-on crypto evolution. So some of the baseline metrics that we need to create to proliferate and help proliferate adoption is trustful reputation, baseline security, privacy, and absolutely necessary is governance. Yeah, so we have protocols for each one of those issues. We have separate protocols in the Samada Research Institute. So what is Samada? We are a fourth generation blockchain. Our underlying protocols are creating this trust that we're talking about through Sybil attack resistance. We're modular, we have smart contracting platform, we have on-chain governance. Happy to talk about it. There's a lot of people who still think it's not possible. We at Samada, through reputation scores, that's one of the basic elements that we can really add to this market. And we're Sybil attack resistant again, and our soft puppet protocol allows that, and the Persona protocol is what we call the protocol that creates self-sovereign identity. Now, here's a quick overview. We are using our voting algorithm as what we call the anchor protocol. It's a proof-of-stake system for block propagation and consensus that uses reputation stakes for block rewards and slashing. So again, it's about reputation scores. Yeah? It's not, you're not staking a tangible currency. You're staking something that's intangible, reputation. Yeah? And that changes the game completely on so many metrics. And then, of course, sock puppet Sybil attack resistance and Persona, as I mentioned earlier. And with that, I'm happy to take some questions if there are any. Hello?
Just to stop somebody from maybe hiding fabricators. Because they're managing their reputation. I don't want to get this out there. So I'm running bad things. My customers are unhappy. Services are provided.
Okay, so how do you build reputation? You build reputation organically, meaning you need to actually show your performance, and you need to post evidence in order to gain reputation scores in the Samada framework. Meaning, you can't simply come in and buy reputation scores from somebody else. You need to show it's a meritocracy. It's a pure meritocracy from the roots up, if you want. Yeah? So you're joining a DAO, and the members of the DAO judge you by your performance on the DAO. They don't know your identity. They don't know who you are. There's no race. There's no discrimination. The only form of assessing how good a person is, what the person's reputation is to look at performance. What does the person actually do? What does the person know? How well did the person do? And how many validation pools did that person participate and win, which all increases the reputation score. Okay, now, so.
What do you mean by performance?
Out loud?
What do you mean by performance? Like reputation, right? What should the user do to be considered better performance?
Okay, so there are various ways that you can show performance in a DAO. Yeah? You can post evidence of something that you claim is truth. It shows your performance. If the validation pool of the DAO votes you in and says, yes, we believe this evidence that you posted, you're building reputation. If you're now participating in voting on other proposals and you win, you're also building reputation. That is performance. How good are you at assessing information that is relevant to the respective DAO? Yeah? And that really goes to the core of what is your skill set. Because if your skill set isn't there, you're not that good. Over time, your reputation score will disappear or be lower. Yeah? Because you can't maintain that performance unless you actually add the value. Yeah?
It seems to me that it really doesn't solve the problem of trust. It solves the problem of control. Because it's the business of the person that owns, manage, and control what is put up there. And you are assuming that some of the stuff that they could be put up there as performance are actually verifiable in a way. They are evidence. There is evidence that can be somehow tested in a way. But that is not the case. And also there's a lot of subjectivity in what performance is and means to different people, different culture, different, So how do you manage all those variables and nuances?
So performance is literally your score. If you don't add value, if you don't win validation pools, if you don't make proposals that win and get upvoted, you just won't have the score. That's a way to look at performance on this. Yeah? But it's unlike what we do in this country, what we do in centralized systems otherwise, yeah, where, FaceTime, are you of the right race? Did you go to the right schools? All these things that we care about, right, that build reputation, those things don't matter. The only thing that matters in these anonymous reputation scores, so in many ways we're removing the human condition. I just want to be clear about this. Yeah? Everything that afflicts society, not everything, but a large part of what afflicts society are these metrics by which we assess others. Yeah? You can't do that in Singapore. You're only the score of what you add and what other people see as valuable and vote out. That's all. So.
Yes, it seems like from what you're saying that your value is actually based on what you add, but you can also look at it from a different point of view. You can look at the scores and kind of aggregate what the needs of the people are as far as the values. So in a sense, you can actually build your own value by looking at the data of who got upvoted, not necessarily as an individual, but like what trends get more upvoted versus what trends get more downvote, and then you can adapt to that and kind of use even a negative score could actually be a value to you as it gives you some feedback.
Exactly right. Thank you for that contribution. Exactly right. Yeah. So a negative score only means the community is moving somewhere else. If you didn't win in a certain environment, you also learn a lesson. Meaning you learn about what the rest of the community believes about the proposal in which you didn't win, you voted and didn't win, right? So a negative outcome is also something that creates cohesion in some ways, right?
Like in the last talk, they say like these technologies, some of them are implementing.
You have to speak up, please.
Sometimes technologies, they're not the most famous in the United States, like the technology they explained in the last talk. How do you think that these kind of projects can help societies in Latin America? Right now you show like the map of problems of trust, and you can say that the ones in red, they're don't want to rent without knowing the person because I don't know where his money came from. There are specific issues that we handle in Mexico and Latin America. How do you think that these technologies will improve the life in Latin America, and how can be that a market for these kind of technologies?
Okay, and this is, a lot of financial institutions have been approaching us about this. Great question. So, how do you create a decentralized reputation score that functions as a... That's coming. We know it's coming, because these old systems, they have so many issues that they're being phased out. We're not quite there yet because of the burst that I illustrated. But these are exactly the types of solutions that people will look to over time. And our children, millennials and their children, very clearly. We can already see that in the data. Yeah. And just one more data point that I just presented this at the Cleveland Federal Reserve, where the central banks are now starting to talk about cryptocurrencies and supporting cryptocurrencies. Of course, for many in the crypto communities, that's a sort of sacrilege. But what they started looking at is the participation rates of millennials in markets, in equity markets. And it's staggering. I don't know if people know this, but it's public data. The only way that millennials are participating in equity markets, on average, is through their 401k, to the extent that they have one. Average savings, $3,500. Yet, there's a lot of evidence that in the United States, over 40% of millennials own some sort of exposure to cryptocurrencies. Yeah? So the question also becomes, and this is just, and I think I have to end now. Okay. Who's going to buy all these equities if the millennials are in the next 20 years, right? So some real questions there that need answering. And so, long story short, yeah. So it's all about building these trust scores to help facilitate crypto adoption and evolution. And I'll end here. Thank you for your attention.
Test. Testing. Test. Test 1, test 2.
Right now to get CarShield for yourself. Friendly, knowledgeable, money safe.
This panel brought to you by Testing, 1, 2, 3. Testing. Can you hear that, guys? Can you hear that good? Sounds good? Good. All right. Do we have the time? Ready to start? Awesome. Welcome, everybody. So I had trouble finding this place. I don't know about you guys. I was walking around. I asked 4 different security guards. Anyway, my name is Tom Sosnoff. I am the CEO of Tasty Trade and Tastyworks. We are an online financial network, and also we own a brokerage firm. We build a bunch of other companies too. I've been around the block a few years, just about almost 4 decades now in this business, and I'm primarily, just to set the stage, I'm a trader. I make a lot of trades a year, maybe 10, 15,000 trades a year, so I use all the products. I use digital currencies in combination with stocks, options, and futures, obviously. I'm here today to talk about digital currencies, trading, the adoption of almost anything crypto, anything digital, and how it's going to relate back to individuals. I'm not an institutional person, so I'm really representing kind of a conduit for individual self-directed investors and their representation into new products. So maybe a little bit different conversation. Everybody here's got different expertise as well. So I wrote a ton of questions, about like 15, 16 different questions for these guys who, honestly, I've met a few, but I don't know any of them well, so this is going to be an experience for both of us, for all of us, I should say. But I'm sure they're all experts. What I want to start off by doing is just letting them just introduce themselves, quickly tell you who you are, and I'm going to keep everything.
Last year we did about 200 issuers trades on the blockchain as well. We just were nominated by IBM for Global Blockchain Award, which is kind of exciting for us today. And our focus is to create a capital market system for entrepreneurs that uses the blockchain.
My name is Scott Diamond. I work with the Chicago Digital Assets Network. I probably have one of the more unique experiences up here just because I'm not a person of finance. I backed into cryptocurrency in a serendipitous way, trying to find new business models for a legacy employer that I no longer work for. And it kind of took on a life of its own, and yeah.
My name is Ross Zhang. I'm the CEO of Huobi Canada. So Huobi is the world's third largest crypto exchange, and we have over 1,000 employees around the world. If you want to do the crypto-to-crypto trading or the OTC, you should come to us.
Hi everybody, Yuri Zamastin, CEO and founder of Coinified and Get Crypto Smart Academy. We've launched an educational platform that's dynamic and non-linear, in addition to a peer-to-peer decentralized exchange. Some of you may have actually seen our presentation at the Bar Chart event where we took second place for technology and innovation.
Hi everyone, I'm Alex Clifford, one of the partners at OneChain Capital. We provide institutional size liquidity, essentially block trades between crypto assets and US dollars. I'm right here in Chicago. We trade with just over 300 counterparties globally. So that can range from blockchain projects to crypto hedge funds to high net worth individuals. And yeah.
Beautiful. All right, so we'll start this off, and I'm going to start this off with kind of a personal question because I am an investor and I'm a trader, and when I look at the amount of occurrences, and I'm one of these fans of law of large numbers and the whole deal, when I look at the amount of occurrences, that means the number of trades I make and the different things I participate in, whether it's alternative to listed marketplace, my smallest number of trades are in digital currencies. And I can't figure out why I'm less attracted to that space as a trader than other spaces. I mean, I don't think it's caught on. So we have 100,000 active retail customers, and we barely scratch the surface in listed, let's call it listed Bitcoin at this point, but many of the other listed products. What's going to change, and why should I be more involved? And that's just my only general question the entire time. I just want to know why I should be more involved as an individual investor, okay? And that's just who I am. I'll start with you, Alex, and we'll go backwards.
Yeah, sure. So I think a lot of the initial interest in cryptocurrencies is generated by sort of a more philosophical, world transformative fascination, right? You see, obviously, this is in many ways a millennial driven movement, and actually, I actually first got interested in cryptocurrency because my little brother, who's 22 years old, is pulling on my sleeve, being like, you have to buy some Bitcoin, like it's going to change everything, right? It's decentralizing custody, it's decentralizing this and that and the other thing. So I think a lot of retail investors, look at the volatility, they look at the fact that the base currency in a lot of these trading pairs is also a volatile asset, right? And it's just a totally foreign sort of trading landscape where a lot of the assets like Decred or like Monero or Zcash don't have USD pairs to trade back into something stable. And there's also still a lot of friction just to get US dollar, to get skin in the game, right? It's not buying Bitcoin on Coinbase isn't that easy yet. They mark it up 2 to 3%. People don't really know where the large access points are to getting skin in the game. So between just a lack of awareness of how to get money in the game and like a lack of understanding about like the usefulness and utility that stems from the technology and the future promise, I think people just sort of write it off as something that, especially the retail investor, write it off as something that they're not going to touch for now.
Ross, what regulatory changes need to happen to get more people the ability to participate in markets?
So I think from the global perspective, we can see, long story short, is basically, the strong economy like China, US, Japan, South Korea, like they're like the biggest of four markets, and they have like a strong regulations, like on cryptos. But for the economies that are not so strong as those countries, we observe that they are more like crypto friendly, or they have like less regulations on it. So I think it depends, but like I think overall the regulators the industry should work with the regulators to educate like each other, both from the industry perspective and also on the regulation perspective. So in order to really like cultivate this like blockchain industry.
So thank you. Steve, I'll switch over to you. What's the one industry that's ripe for disruption because of cryptocurrency right now? Real general.
Well, I guess when I look at that, there's 26 million companies in the United States that don't really have a capital market. So I think the crypto, not currency, but crypto security world could be an opportunity that allows them access to capital with the blockchain allowing proof of ownership and immutable records along the way, with interest and dividend payments along the path, which allow traders access to a significantly greater volume of corporate tradabilities.
So do you think that, so just a quick follow-up to that, do you think the listed marketplace and the way we raise capital right now to finance innovation, is that going to change? Is that a risk to the current model or no?
Oh, I think it's a significant risk. If you look at the venture capitalists and the PE model, they live on friction. They live on finding the one deal that nobody else knows about. Our job is to provide and neutralize that marketplace so all of those 26 million have a forum that they can work in. One thing we should all be watching and cognizant of is the new tax bill of opportunity zones. That's going to create a 10-year tax moratorium for income tax and capital gains tax for any investment in opportunity zones. So it's going to create a whole new world of tax-advantaged investing.
I like it. I'll throw this one over to Yuri. Yuri, as Bitcoin has finally been brought to the listed markets, its popularity seems to wane once the product. Now, it could all just be timing and cyclicality. I understand all that, but when it came to listed marketplace, like listed on the CME and the CBOE and places like that, it was 18,000 when it went live, and now it's a third of that. Do you think merging Bitcoin's dark web past with today's business news has hurt its popularity?
I think so, and I think the other challenge is that unlike some of the other traditional investment stocks, ETFs, commodities, what have you, you don't really have a 20-year history behind it, and so it's challenging for new entrants into the, whether it's from a retail perspective or a trading firm perspective, for people to get in and really understand, you know, the novelty effect, the cachet has wore off a little bit now that you have greater adoption, so people are trying to figure out what's going to happen, but most importantly, if you kind of think about it, you know, there's 1,600 plus currencies out there. And so in any traditional market, for something like that to maintain and survive long term is not really feasible. So people are starting to look at other things, whether it's, you know, Zcash, Monero, whatever it is, or whatever the options are, or from whatever perspective they're interested in. You know, you're seeing a lot of different things happen, and everybody started out with Bitcoin, but Bitcoin's not the only player in the space, and there's other, you know, big tool or big solutions out there that are potentially better, more scalable, and what have you.
That's good. Hey, Scott, I'll kind of ask you the same question because this is kind of one of my favorite topics, only because I'm not sure if there's a transition going on between, and I'll get to this question actually in a few seconds, but from innovation and creation to actual, you know, functionality. And so I'll ask you kind of just the exact same question. Do you think merging Bitcoin's kind of history into what it's become today with respect to business news has, you know, hurt its popularity?
Well, I'm going to real quick just go back to your very first question.
Sure.
You described yourself as not being much of a crypto trader.
Yeah.
I'm completely the opposite. And you know, there's a group outside ATN trading and just using their engine as a non-professional trader.
Sure.
Probably about 90,000 trades this year. You know, because the market is 24/7 and the volatility is there. And that's where the opportunity is, I think, for somebody who's maybe not so sophisticated. But to get to your question, I mean, I think a lot of people, when they come to Bitcoin, it was actually very cringe-inducing last year when I would turn on CNBC and I was literally watching my watch and be like, they can't go 20 minutes without talking about Bitcoin. And everybody just talked about the price. And to me, that's like number 9 on the list of sexy when it comes to Bitcoin. I take a look at these platform asset classes as being, you know, truly, I take a look at what I'm calling the future value of utility. And so the utility of these baseline protocols are actually increasing. The fact that it was a bit of an anomaly that business press started jumping on the bandwagon and brought a bunch of people in who are only interested in price, speculation, and now a lot of those people have lost interest because they said, well, Bitcoin's down 65%. It's like, well, not compared to 24 months ago. So that's the other thing too. I think that the professional investor looks at things in very small snippets. What were my profits this quarter? What were they this year? Whereas I take a look at it as this is like a multi-generational experiment that's out there, and we just happen to be fortunate enough to be alive and participate at the very beginning.
Beautiful. So just for a little bit of background, when we talk about volatility, the Bitcoin volatility fluctuates. Let's say, I'm not sure what it is today, but somewhere between 80 and 120. Let's use that as kind of a round number. Volatility, by definition, is expected move. And the reason that digital currencies, specifically Bitcoin and others that are more actively traded, are so interesting for traders / investors is because they are a speculative asset that actually moves, whereas the S&Ps move, just to give you an example, average volatility, let's say 12 to 14%, and Bitcoin at 10x of that makes the expected move, you know, 100% versus 14%, which is interesting to traders and / investors. I mean, that's the story. The negative side to this, which I'll throw back at, let me throw this one over to, let me throw this over to Ross, just for a quick second on this. The negative side to it as an investor / trader is that there is a very limited derivatives market of the underlying. When there's a limited derivatives market, meaning there's limited derivatives that you can actually participate with, which I don't understand why there is such a limited derivatives market. The reason I say that is because that's where the strategy comes into play. It's one thing to be directional, it's another thing to be strategic. So why is there, and I'll ask somebody else the same question, but why, where's the derivatives market going to come from when it comes to, you know, all of these products? The marketplace is big enough. The marketplace, I don't know what it is right now, 600-700 billion, plenty big enough for a underlying derivatives market, but we don't have it yet.
Well, yeah, I agree with you that, you know, we only have like a limited options on the derivatives, right? So like the CBOE and CME have the Bitcoin futures. But like in terms of like the overall coin offerings, like we still don't see a large number of derivatives. I think one of the problem is, you know, how to value those like coins and how you can like, and then, you know, you need to calculate, you know, how to value the derivatives. And then, you know, and because, you know, right now in the market is still like speculators and, well, like lots of them are speculators and they're like a short-term investors. But like with more and more like quant traders or, you know, the institutional investors come to play. And, you know, it's like a chicken egg, you know, for those big players to come, you need like infrastructure, regulation, and also like the instruments that, you know, those players need. But at the same time, you know, I think the industry needs to like, because like original, like all those like inventors of Bitcoins, they're geeks, they're from the technology side. And with more and more people from the traditional like financial background, and then, you know, they can come up with you know, some like derivative markets for all those coins. I think, you know, we're seeing that, you know, maybe within a year or so, like we'll see a large booming for the derivatives market.
That's good. You know, it's interesting, but as an investor, we use products that are highly leveraged, like options and futures, and even stocks intraday are leveraged. You know, depending on the type of account you have, either 4 to 1, 2 to 1, or maybe even 6 or 16 to 1. But in the world of digital currencies, it's very hard to get leverage. So Yuri, like, what's the deal? In order for something to be strategic, it needs an underlying derivative, and it also needs a leverage. You have to be able to leverage it. And one of the reasons there's been a successful marketplace for, you know, different futures, different commodities, and even different currencies and things like that, is the leverage in currencies could be in a spot market 50 to 1 and in a listed marketplace 16 to 1. But in Bitcoin or in any digital currency, it's basically 0 or whatever you can negotiate. Even at our firm, you know, we're holding 80%. So it's very difficult to trade. It's expensive to trade. That's all. And sometimes people realize that. How's that going to change?
Well, I think it has to be greater adoption. It has to be more stability. The regulatory environment, to Ross's point, has to come into play. You know, Scott mentioned something earlier with respect to kind of how the industry is going to shape up. And so one of the key challenges from my perspective is that for all of this to change, you have to have Main Street come in, but you also have to have the trading firms and the enterprises actually support the challenges, right? And so until they do so, it's going to be the chicken and the egg, who's going to come first, because the trading firms that we're talking to, everybody's sitting on the sidelines and essentially saying, we're not going to kind of take a leap of faith until we know that this is consistent, this is stable, and there's liquidity. Because you also look at some of the other coins, you know, you look at, everybody talks about the top 10 coins, Ripple, Ethereum, you know, Litecoin, what have you. You look at number 1600, 1599 on the list, you can barely find a place to trade those. And if you do find a place to trade those, you know, it's 1020x. And so that's always the challenge of what's going to survive, what's going to be the adopted standard, what's the underlying technology behind it. And from your perspective, Tom, as you said, you know, how do you look at that from a longer term kind of investment perspective?
That's good. Steve, I'm going to throw a question at you, a big picture question. I got a big story here. It's on the reality of the adoption of blockchain. And we put together this question, so I'm just going to read it off. Things like cell phones, PCs, and tablets are adopted faster than new technology in finance for obvious reasons. An example would be the first ATM was deployed in 1968, and it took 20 years for it to be common. So what do you, or the panel in this case, think the mass adoption of blockchain will be? Like what year? How far are we away from mass adoption of blockchain?
This is committal, isn't it?
Yeah. I want to throw something big out there because you know what? There's no context. Like what drives me crazy sometimes is there's no context. I want somebody to kind of stick their neck out and throw a little context around it.
3 years and 2 days.
Okay, beautiful.
No, I think you know, we're in a very regulated market. We have SEC guys and FINRA guys every week. They put at least 2 guys in our office to learn about what the blockchain is. I think they're learning. I don't think they're getting as scared of it as they were. I will tell you that they've forced us into domestication of data stream versus the blockchain kind of ubiquity. So I think they're getting more comfortable, but I do believe it's 3 years away.
3 years away. What do you think, Alex? Same kind of question.
Yeah, I mean, I think further. I'm more like 10 years till things really become mainstream for user-facing decentralized applications. There's, you know, a laundry list of issues with Ethereum and a lot of the smart contract-enabled blockchains that are currently showing promise. You know, there's a lot of experiment right now at the consensus layer with a lot of these protocols. So you know, over the next 12 to 16 months, I think you're going to see ecosystems like EOS and a lot of these delegated proof of stake consensus mechanisms come to fruition in some regard. You know, there's obviously the trade-off is decentralization to scalability, right? That's sort of the major trade-off in terms of getting decentralized applications to a point where people can actually use them. So yeah, I mean, I think we're more like 10 years off.
Beautiful. Scott, I'll throw this one at you. Okay, cryptocurrencies are not by nature transactional. No one's using them to pay for iPhones, to buy tickets or movies, whatever. You know, I saw a hot dog vendor in New York accept them, but other than that, it's limited. Does crypto need to be transactional in order to survive? And how are the transaction fees hurting small crypto dollar transactions?
Well, this you know, great question. What's going to happen in this space is that people are going to have to start building services, basically like second layer services, where somebody like your grandmother can use Bitcoin without knowing she's using it.
Right.
And that's really what it is. It's, you know, how complicated was it to send an email in 1988 versus, you know, 2018? And that was a 30-year, you know, kind of a 30, 40-year transition there. So, you know, so that will start happening. I mean, I am using Bitcoin. I'm actually buying some Pearl Jam tickets for Monday night using Bitcoin because the person I'm buying them from prefers to have Bitcoin and not US dollars. So those types of things will continue happening, but I think what's going to happen is you're going to see the transactional nature of, say, for example, Bitcoin become much more accepted and used in economies that aren't necessarily as developed as you know, our first world economy is here. There's probably about 15 different ways people can pay for things out of their pocket, and they can make choices on what they're using based on interest rates on cards, or if they want to pay with debit, or, you know, even still writing a check. I'm sad to say I actually saw that this week. But yeah, so I mean, that's where it's going to happen. I think you're going to see the merchant adoption happen outside of the first world economies, and then those solutions are going to cascade much more quickly. And to that point, this industry is going to evolve faster than I think a lot of people imagine, because when there are going to be successful implementations, because everything is open source, you don't have to sit there, go out, buy a Motorola, you know, brick phone and reverse engineer it to try to figure